Hi, I'm Tim from SPX Option Trader. One of the fastest ways to lose money trading 0DTE options is to focus on how much you want to make in a month. Now I know that sounds strange, but it's true. Focusing on how much you want to make often leads to taking too much risk on a single trade. And when that happens, it doesn't take too many losing trades to cause real damage to an account. Most traders begin with the wrong question. They ask, how large of a position should I take? But the better question is, how much am I willing to lose if and when the trade fails? And that answer should determine the position size. You can think about this the same way people think about insurance deductibles. When someone chooses a deductible for car or home insurance, they choose an amount they could comfortably pay if something goes wrong. It's not based on the value of the asset. It's not based on how much money's in their account. It's based on what loss they can handle without stress. Reality is, trading works the same way. Before entering a trade, a trader should already know the amount they are prepared to lose if the trade fails. And just as important, they should be comfortable if several of those losses occur in a row. And that total potential loss is what should determine position size. Now, a common approach to this topic is to focus only on rules about risk percentages. For example, some suggest never risking more than 5% of an account on a single trade. Others prefer 1 to 3%. Now, certainly rules like that can be helpful as a general guidance. But the percentage itself is not the main issue. The real question is whether the potential loss is something the trader can tolerate, both financially and emotionally. For some traders, 5% may already be too large. For others, it may be acceptable, depending upon one's strategy and account size. And what matters most is that the possible loss is understood before the trade is entered. For example, if a trader has a $50,000 account and follows a 5% risk guideline, that means the maximum acceptable loss on a single trade would be about $2,500. But that number isn't really the point. The key question is whether that loss is something the trader could comfortably accept if the trade fails. Now, in this example, if losing $2,500 would cause stress or hesitation on the next trade, the position size should really be smaller. See, the percentage itself really isn't what matters. Comfort with the loss is. And it's important to think beyond a single trade, because every strategy experiences drawdowns, and those drawdowns can include multiple losses in a row. And position size must take that into account. This becomes especially important when trading same-day expiration options like SPX or SPY. In 0DTE options, prices move very quickly, and a trader needs to understand their risk before entering the trade. That includes knowing where the trade will be exited if it goes against you, and understanding the maximum potential loss. Because of that, position size must be chosen very carefully before the trade even begins. It's important to realize drawdowns are a part of trading. Every strategy experiences losing periods. Even the best of strategies will have stretches where several trades in a row just do not work. In my own trading, there have been periods with multiple down months in a row. Drawdowns are simply a part of trading. But because I was trading a position size where I was comfortable enduring those losses, my risk remained controlled and I was able to continue trading normally. That kind of stability is only possible if position size is small enough to survive the losing periods. See, successful trading is not about avoiding losses. It's about making sure that losses remain manageable. A simple way to evaluate position size is what I often refer to as the sleep test. If a losing trade causes stress, sleepless nights, or hesitation on the next trade, then your size is simply too large. Trading decisions must always remain calm and disciplined. And if the size of a trade creates emotional pressure or stress, your judgment will eventually suffer. Your position must be small enough that a loss remains manageable. See, the real question in trading isn't how much you can trade. It's how much you can afford to lose if and when the trade fails. Position size should always be determined by the loss you are prepared to accept. A single trade should never make or break your account. Because the fastest way to lose money in 0 DTE options isn't being wrong. It's risking too much on a single trade. In trading, survival comes first, and survival begins with position size.